The mainstream narrative asserts that fiscal support provided by governments during the early stages of the COVID-19 pandemic created robust aggregate spending pressures, resulting in a demand-pull inflation. The voices from this camp suggest that the solution lies in central banks increasing interest rates to choke off what they perceive as a spending excess. But MMT views this differently. According to MMT, the main pressures driving the current inflation have been on the supply side. During the pandemic, restrictions on businesses and income support schemes resulted in an imbalance. The service sector contracted while the supply of goods faltered, but demand for goods remained high due to ongoing income support and reduced opportunities for households to spend. This temporary imbalance generated inflationary pressures, which MMT suggests would ease once factories resumed production and the service sector reopened for business. MMT argues that the mainstream response of increasing interest rates is misguided. It points out that the main inflationary drivers are not sensitive to interest rates and have been abating on their own. By increasing interest rates, central banks have caused a significant redistribution of national income from low-income mortgage holders to those who hold financial wealth. In fact, MMT suggests that the shift towards higher interest rates has fueled inflationary pressures itself. Businesses with overdrafts or other debt have experienced increased borrowing costs, which those with market power have passed on as higher prices. Additionally, in tight housing markets, increased costs for landlords have resulted in higher rents, contributing to the Consumer Price Index, or CPI, pressure. MMT also highlights that this current inflationary episode bears little similarity to the inflation driven by increasing wages in the 1970s following the OPEC oil price shocks. The fear of wage-driven inflation, used by central banks to justify their policy decisions, is not substantiated by current evidence. In conclusion, the current inflationary episode does not negate the insights of MMT. MMT has always emphasized the inflation risk of resource shortages. It argues that the major inflationary pressures have been supply-side driven and not sensitive to interest rates. The mainstream response of increasing interest rates has not only been misguided, but has also contributed to inflationary pressures. This perspective challenges the traditional thinking about deficit spending and its impact on the economy, shedding new light on the discourse surrounding inflation.